I find it hard to believe that the labor force is really as strong as they say it is.
So Christopher, today we'll be taking a look at the US economy and the Federal Reserve. So starting off with the stance of the Federal Reserve. Now, that seems to be a stance of caution. And is this justified looking at the US economy and, for example, the post-Brexit uncertainties?
Now, in regards to their policy, it is one of caution, but given where we are in the U.S. business cycle, they should have been at least on the path to normalization. Realistically, the Fed should have began increasing interest rates. Their window of opportunity really was between 2012 and 2014. But in 2015, we really seen some indication that the U.S. business cycle was beginning to slow. We've seen growth in non-farm payroll slow, industrial production slowed, consumer spending is stagnant. It is one of caution, but given the fact that we're at the end of the business cycle, or at least going towards the end of the business cycle, they really have no room to cushion a potential U.S. recession.
So you've mentioned there that the Federal Reserve actually missed their window of opportunity, and that almost ended in 2015. So we're now halfway through 2016. In your opinion, should the Federal Reserve raise interest rates anytime soon, and what could the possible implications of that be?
They should, but since we are so far along in the business cycle, that could pose risks. Typically, when a central bank begins increasing their interest rates, it's going to strengthen the currency. Now, if the dollar strengthens, that could have implications on commodity prices, and which would mean that they would pressure those prices lower. And then also, a stronger dollar would put pressure on U.S. exports, which would continue to drag down U.S. manufacturing, industrial production, things of that nature. And the stronger dollar will it will continue to damper the Fed's target inflation rate, and then also along with an increase in interest rates, that could pose risks to U.S. equities, because investors need to take interest rates into account. And we could see, considering where corporate earnings are heading, where it looks like we're heading to the 7th consecutive quarter of year-over-year earnings declines, that could pose a risk for a sharp pullback in U.S. equities.
So going back to what you said, in 2015, we have seen a slowdown in NFP data. Now we've mentioned corporate earnings also seeing a decline. So now taking a look at the current status of the US labor market, what is the status at present?
It's pretty weak. A lot of times we'll see the general consensus focus on the headline number month to month. But if you really take a larger picture of where non-farm payrolls growth has really peaked out, if the year-over-year change in non-farm payrolls peaked in February 2015. So we're going on 17 months of decline from the peak. Janet Yellen and a lot of economists say that the U.S. labor force participation rate, which is hanging at multi-decade lows, is because baby boomers are beginning to retire. Well, the data isn't showing that, because the senior citizen demographic, so to speak, is at record levels. So there's something strange about that. So if we're seeing a spike in these these hirings of older individuals, and the key demographic is still lagging behind, I find it hard to believe that the labor force is really as strong as they say it is.
And you're right that if there is a decline in labour market in the US, then it would be expected that the Federal Reserve would ease. So what's your outlook for the Federal Reserve movements? What moves are you expecting in the next few months?
Generally, what I see happening is I believe Janet Yellen wants to remain as easy as possible. She doesn't want to throw off the markets in any sense. What we will likely see is rhetoric out of the Federal Reserve to remain as dovish as possible. Clearly, if the Fed is introducing QE4, we, investors will take that as a sign as the economy is weakening, and stocks may fall regardless. And I wouldn't be surprised when push comes to shove if the Federal Reserve cuts interest rates and eventually cuts them into negative territory.
Fantastic. Well, Christopher, thank you for joining us on the line. It was a pleasure to have your insights.
Well, thank you for having me.
That's all for myself and Christopher, but if you did like this interview, do like and comment on dukascopy.tv.